Good afternoon, everybody. Welcome to Selecting an Option Strategy webcast. I'm Connie Hill. I'm happy you would join me here today. This is a webcast that we can explore different strategies depending on what the market's doing and see if it gives us some, a direction of maybe some strategies that might be good for the market conditions. So we're going to do that today. One of the requests I've had from you is to maybe look at some of the strategies that we have not been doing so much. So last week we did a double calendar. I don't know if any of you traded that along in your paper money account. If you did, I'm curious to know how you thought about that, because we'll explore that as we follow up on our strategy from last week. I am joined in the chat by Cameron May. Thank you for being here, Cameron. He will help me watch for questions. Most of them I'm going to try to catch as I can, but there might be some that Cameron has to help me with. And so we do want to answer your questions. Go ahead, get those submitted. Hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. We'll post educational content, things we observe about the market or a stock or things that are going on that we find interesting, that we think you might like. We will let you know about it. Let's go through our disclosures and start into our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for informational and educational purposes only. Don't consider it a recommendation. Schwab doesn't recommend the use of technical analysis as the sole means of investment research. We will be using the Paper Money software application. It's for educational purposes only. Fantastic tool, especially as you're exploring strategies, wanting to learn how to trade certain things. Man, do that out in your paper account first. Investing involves risk, including the loss of principal. If we talk about anything as far as probabilities, keep in mind it's theoretical in nature. Past performance of any security or strategy does not guarantee future results or success. Short options can be assigned at any time, regardless of the in-the-money amount. That's one difference in paper money, is it will not assign early, but the real market can and will assign early. So we'll talk about that as appropriate. There is no guarantee that an execution of a stop order will be at or near the stop price, right? Those execute as a market order. We don't really know what price they're going to get filled at, but we hope that they just get executed quickly. All right, so those of you who followed along and did in your paper money account our trade that we did last week, of a double calendar. I'm curious if you did. Go ahead, chat in, let me know if you did it, if you didn't do it. Nobody will be shamed if they didn't do it, okay? But because you're interested in learning some of these other strategies that might, maybe they're not going to be your bread and butter strategies, but you want to understand them and know when it can be appropriate to use them. It's a great way to do it, is just follow along on these example trades. We'll go take a look at the market. Looked like it rebounded off its lows a little earlier. We'll see if it made enough progress to get back up. I don't think it did. We'll talk about maybe some different strategies that we might consider. And then we're going to look at last week's double calendar. We're going to spend a little bit of time on it because I want you to understand it. And then we've got a new trade set up here. Okay, Sharon said she did them. Jacinka, I just totally massacred that. You weren't here, so you didn't do it. Okay. Very good, Sharon. You get bonus points. One of the things when you trade these example trade that we do in your paper money account, and you follow it and you track it, it gives you an idea. Like you come across a scenario and you're like, I don't know what I do in this situation, or what should I do with this? But if you aren't really paper trading it, then it makes it a little bit harder for you to really grasp some of these nuances because you're not following it. Okay, so that's why I'm going to encourage you to do that. All right. Let's go out to our paper money account. Let's go pull up. Let's take a quick look at the market first. And let's go to SPX. Let's see here. How did it end up? Oh, it looks like it did end up today. It did bounce off its lows. I mean, it was down here. Closed a little higher. Looks like it ended up being down about 0.63%. Has the trend changed? I wouldn't necessarily say it's changed, but maybe there might be an area of support that it's using right now, maybe around See if I can get that. Maybe something close in that 65.58 area, maybe 65.60. Looks like that could be an area of support. I'm going to go ahead and extend that to the right. There we go. Didn't go that far, but it did 2 days ago, right? Came clear down there and went back up. How about the NASDAQ? I think it was a little bit more weak today than the S&P. Looks like it ended up down 0.36%, so it didn't end up as down. Looks like it recovered off of its lows here. And let's take a look at the Dow Jones. Dow Jones, oh, I've still got my Fibonacci on there from a long time ago. It looks like it was down 0.65%. So they're all kind of down, 0.5% or a little bit more, close to that range. And then we'll do the Russell 2000, small cap stocks. Oh my, that's a big red candle there today, isn't it? Down more than 2% here today. So yeah, I would say made a new all-time high yesterday. Pretty big bearish candle today. What do you think the news that motivated that sell-off in the market? As you paid attention to what's been going on, if you have an idea of what you think happened to kind of cause this market action today, let me know. Go ahead and put it in the chat. Let's see here, a couple questions here. H. Marcello, I'll just go with H. Marcello. You'd like to know how to manage the losses. We absolutely always want to know how to manage the losses. We'll talk about that in our double calendar, although it was a winner for us. So yeah, we'll talk about that. And maybe you could even add on there if there's something more specific than managing losses, like managing losses if X scenario presents itself, or if, the stock, whatever it happens to be, what strategy you're thinking about, because generically, I don't know that I'll give you some good information, but if I know what strategy we're talking about, or maybe even something you traded, we can look at that a little bit, put it in context here. Ricebird says, I was making a lot of live trades last Thursday, capturing profits. Good timing, I'd say. Randy says, I noticed that there are shaded red and green on the charts. What script was used for this? This is actually a script, a James Boyd script that sometimes I'll have up, and I know some of you guys like to use it. It's the whole 20-day, 10-day, 20-day moving average, and then it has like this shading in here. He's got another script that also put green dots and red dots on it. I didn't have that one up. I just happened to pull this one up for some analysis that I was doing earlier today while I was doing chat for his class. So I'm happy to share that with you. James has a lot of some nice scripts that he shares out on his X account. If you go, make sure you're following him on X, you look at that top post, he's got a sheet there that basically lays out all these different scripts. Let me see if I have this one sitting out here in my scratch pad. I am not seeing, oh, nope, that's not it. That's something else I'm going to share with you. I'm not seeing it right now, but if that is something that you would like, let's just go out here. I'm going to go to my studies. And you can see it's a shared whole moving average JB. Lovely. Let me just go ahead and click on that. And then I'm going to share, and make sure when you bring it in, go up to your setup, open shared items, and either keep the name that it's been given or give it a name you'll recognize, okay? Because it'll probably come in with what I've named it, shared whole MA_JB. That lets me know that that was James's version of it, okay? I'll just leave that here. It'll probably come over to you with that name on it. Remember, anytime we share scripts, they're not guaranteed as to accuracy or timing, okay? Keep that in mind. I'll go ahead and put that out there in the chat for those of you that are here live. For those of you that are not here live and you're watching on the recording, let me do this. Let me go back to the SPX chart here. And I'm just going to do a little text box, and I'm going to put it in the text box. So those of you that are listening to this on the recording and want to see what that script is, those are a little bit bigger letters so you can see it there. Okay. Yeah, somebody thinks I'm breaking up a little bit. Hopefully my sound is doing better right now. I'm not sure why it would be breaking up. Okay. We need to decide to buy a call or a put. What strike or delta do you go for? We'll talk about that when we get into our new strategy for today. Okay, we'll get into that. Okay, so there's that script. The other script that I do want to share with you because it may come into play, and I've got it up in my charts, even though some stocks it's not showing for, is this market maker move. Okay, we talked a little bit about it last week, and basically we're going to be talking about it here again today. The market maker move script. Okay, those of you in the recording, just pause, come out here to my scratch pad, and you can see what that is. The market maker move is what's being priced into the options for whatever news event is coming up. Sometimes it's earnings, sometimes it's a product announcement, it's an FDA announcement. There could be a number of things that it could be pricing in volatility for, and it gives us an idea. Now, we're not going to see it on the indexes here, okay? Let me pull up a stock. This isn't a stock we're going to use today, but let's just see. No, it's not there. Let's try Apple. Yeah, right now, some stocks will come in with a market maker move, and really, we'll go through this. We're going to use the straddle price to tell us how much the market maker is expecting the move to be. But what it does, that little script I just put out there, puts on your screen here, market maker move for right now is $2.34, which is not a whole lot, especially on Apple. That's like, this is even less than a % move. And then these yellowish orangish lines come on your screen here, and they price that out. What is $2.34 higher than the price of the stock and what's lower? Puts those lines in there so it gives you an idea. Okay, that can be helpful as well. Okay, now let's go and review what happened here on UAL. We thought they were going to be announcing earnings on the 13th. And it turns out they really didn't announce things until the 15th, last night. Okay. So we got in this trade on the, let's see, today's the 16th. So we got in on the 9th. That's the day my mouse is sitting on. Okay, this candle here, this is when we got into the trade. We're not really looking for a technical entry of any sort. Doesn't have to look like anything in particular. We got in solely because of earnings coming out and wanting to capture implied volatility that's usually priced into the front week options or the week where a stock will announce earnings or whatever the big event is. Okay. So we thought they would announce earnings here. Turns out, actually, here's the 13th. They didn't announce till last night, and it did not react to the earnings announcement until today. So today is really the first day we kind of get to see what happened. So we had put on a double calendar. We didn't know which direction the stock was going to move, right? We just were expecting a move because it was earnings, and that this is a stock that has made some pretty decent moves during earnings. Let's see if I kept a note here on how big the move was expected to be. The expected move here was $8.45. Okay, so we got in pretty close to the closing price of actually the opening price of the next day, because when we did our class, I'm going to move that. We didn't get our order in until the next day because right now the market's closed. Okay, so really we would have got filled on that should be the 10th. Is that the 10th here? Yeah, that was the big sell-off day on Friday. So we got filled here. In any case, it's interesting. So we knew we took the straddle price, the at the money option for that series of contracts where they would announce their earnings. So we didn't pick the ones that expired in 2 days. We picked the ones that were the next week. Okay, we wanted to sell that front month volatility. And so when we took that at the money straddle price, it priced out to be, if whatever that value was, the current price of the stock plus whatever that premium was, added up to about 109. And so we did a 109 call calendar. And then we did, the other number came in at 93. So whatever the current price of the stock was minus the market maker move came down here to about 93. And that's where we did our put calendar. Okay, so we collected some pretty decent premium on this. And I'll tell you what I did, and then we're going to go look at the numbers. So really, look how much it traveled today. It got up as high as 106.45 up here at the highest, which is still a little bit below our 109. And then it came down, it came close to 93. And then as the market started to kind of rally a little bit off the lows today, this stock rallied up a little bit as well. So the market maker move here basically is over. Okay, even though it's showing up a little bit here. Implied volatility came crushing out of both those options, which is what we expected it to do. And in a double calendar, where we really get into trouble if it goes way beyond one of the strike prices. Okay, if it goes way beyond them, then it can end up as a losing trade, but it can end up as a beneficial trade if it goes close to one of the strike prices, or in this case, kind of stayed in between the two. So I just kind of let it play out here today for a little bit of time. And then when it had been down here around 93 and the market started to move up here a little bit, that's when I determined, okay, let's take our profits and get out. Okay, let's lock in what we earned essentially. We got the credit up front, but we had to buy a couple things back at small prices. Okay, so here are the numbers. And we're out of the trade today because I got us out of the whole thing. All right. We got into the trade and paid $1.04 for a 109 calendar and our 93, I should say our 109 call calendar and our 93 put calendar. The total on it was just 104. One of the things we had going for us is the front week that we sold that had a lot of implied volatility. We intentionally did it because we wanted to see and try to capture a lot of that implied volatility priced into the options, because the news comes out and it's kind of like the balloon bursts, right? And the pressure comes out and that implied volatility comes draining out, especially on things that are due to expire, say tomorrow or the next couple of weeks, really comes flushing out of those pretty quickly. All right. So let's walk through the math here. And essentially, we paid $1.04 for it. And then we went and bought back some short options. Okay, so we bought back the 109 call for 4 cents. That was pretty easy. Now, we could have possibly tried to let it expire worthless tomorrow. But you saw the range of what that stock was moving today. There was a little bit of volatility, a little bit hard to maybe determine where it was going to end up, even though, yeah, it ended up down on the day. So we were able to buy that back for 4 cents. And then on our 93 put that we bought back, we basically paid 27 cents for it. Okay, so on our 104 or 109 call, our short call right here, we got $1.70 out of it initially. We had to go buy it back for 4 cents. So we made most of the premium on that one. On the 93 put, our short put here, we brought in $1.01, so not as much premium. And then we ended up buying that back today for 27 cents. Okay. They did not execute one by one. Okay. First, I did this one for 4 cents. And then I got out, I was actually planning to get out of all of it, but it didn't group all of them there together for me. And so where we we lost a little bit of money. So from our initial, we got, let's see here, $3. Let's see, $2.52 was a credit. We would need to subtract the expense of buying back the put for 27 cents and subtract out for buying the call of 4 cents. And that leaves us a net of $2.21 per contract. We have 3 contracts. So altogether, not including fees and commissions, right? Those are always going to be on top of it. and we're going to have it going in as well as coming out. Okay, netted us about $663 for roughly a 7-day trade. Okay, so you'd have to determine for yourself if you think something like that is worth it. Okay, let's see here. Looking to see if there's something I need to answer if Cameron's, it looks like Cameron's helping me out with this. Okay, so let's see who did the trade with me. I'm trying to remember who said, yeah, I did it with you. It was Marcelo. Was it Marcelo? I think it was Marcelo. One of you, now I can't find it, did trade it along in your account. If you had questions as you were watching it, probably today as well, especially today when finally we got to see what the stock would do after the earnings announcement came out, go ahead, send that in, okay? Because I want to make sure that we answer the questions that came up for you, okay? And whether it's worth it to you or not, some of you are saying yes, and some of you might go, I don't know. I think a key thing here is understanding. And so today what we're going to do, we will note market selling off a little bit, but the trend is still the same, right? Some of the indexes made new highs yesterday. Although I'm going to say we're having a little bit more volatility in the market, a little bit more movement, which when you're new to volatility can be really uncomfortable. Okay. As you are in the market for a little bit more time, you kind of get a little bit accustomed to it. I don't want to say you get calluses, but kind of to some degree, you get some calluses because you're used to seeing the volatility. And there'll be some stocks that you have that you work with that maybe aren't as volatile. And maybe you intentionally do that. And there could be other stocks, like growth stocks, that that might vacillate a lot more. You'll have to kind of develop a comfort for having them, or maybe you don't, and so you don't work a lot with maybe those kinds of stocks. Okay. Art says, the calendars are just not your favorite. That's okay. They don't have to be your favorite. Marcella, you said you got out about 210. I wonder if you got out similar to mine. We ended up with what I tell you, 221, and if your overall was $2.10 per contract, fantastic. Yeah, and if you had a question there, let me know. Chuck says, why would you do this type of trade versus a collar? A collar usually is something you might put on to protect a stock position, right? A collar is buying a long put, selling a call. Many times that the money you bring in on that call can pay a good part of the put that you're buying, but it only it only works one direction, right? If the stock has a bad announcement or does whatever and it dips, typically both of those options are going to benefit from that. Okay, so a collar I'm going to call a protective strategy. This that we were doing here, this double calendar, I'm going to say is more speculative and a way that some users might or traders might consider using that strategy because of the high implied volatility priced into the front week or the earnings week, whatever it happens to be, because of a big announcement coming out. So totally different approaches for different situations. You wouldn't necessarily do a double calendar if you were holding UAL stock. Because it's more speculative versus the collar is something you're doing to try to give yourself a hedge as they go through whatever that news is. Okay, so that I would say is probably the main difference there. Okay. Good question, Chuck, because you're trying to get an idea of when it's appropriate, right? So what I wanted to do today is I wanted to walk you through the process that I went through earlier of picking what kind of stock might be good to do a double calendar on. Because I gave you some guidelines last week, but I didn't walk you through the process. And today I'm going to walk you through a little bit more of the process. Now, some of the things I told you last week, let's see if they're still written down here. We want to use stocks typically that, I think this is where I wrote it here, are at least $40. Stocks that are lower than that, could you still try to do it? You could still try. It might be a little bit more difficult, okay, because there isn't a big separation when the price of the stock keeps getting so low, okay? The other thing is we wanted whatever we were selling, that front month of volatility or front week of volatility, we needed it to be at least 10% more. So on those short legs, we wanted it to be at least 10% more than the long leg, what the implied volatility was priced into that series. Okay. So earlier today, I went out to the Market Watch, went out to the calendar, and I was just looking to see there's some big names, because many times these large cap stocks that do a lot of trading activity have more liquid options, fair bid-ask spread prices. Okay. And so I was just kind of looking for some of those big names off of the calendar. So I moved it to October 19th to the 25th. That's next week. And I picked through some, I think it was on Tuesday, I picked through some, and I'll show you what some of those were. And then I went over to Thursday as well to try to identify some that, again, were bigger cap stocks, typically have a lot of trading activity. And typically, the other thing with these is you want something that moves big over earnings. If they don't move big historically, they're probably not a good candidate, because one, they're not going to have a lot of implied volatility priced into their options because they don't typically move that much. And so you're just not going to be able to find it. Okay. So let me show you the first stock that came up here. And I'm going to walk you through a few before I show you the choice. Okay. Let's do this one first. Mattel. Mattel sometimes has had big moves. And you could start out here going on a 1-year chart, and you can go, oh yeah, they had a big move there. Look how big that move was. They had a pretty decent size up move here. We talked about those two gaps. Okay, big gap here, another big gap here, and then their most recent earnings, man, it gapped down and slid. Okay. But what's the price of the stock right now? The price of the stock is $18. Because of that, we're just going to strike it off. You can paper trade it if you wanted to. There's not a problem doing that. But it's a reason that I didn't choose it as one of our examples is because it's not a big enough price. It's not $40 or higher. Okay. Let's look at another one. RTX. RTX, it's a $157 stock, and it has had some decent size moves in it. Okay. Let's go. They're not as big as Mattel. Mattel had some pretty large moves. I mean, if we look here, we can see that doesn't look like that big of a move during that earnings. Go straight up here. Looks like it gapped up and then pulled back. So a little bit of a move there, not enormous, not like a big, you could drive a big truck through it type of thing. And then over here, we did get a decent gap down on that earnings. This earnings, it looks like it kind of gapped up a little bit, but continued to run. So it made a pretty big run after the news was out. And then the one thing you can always count on is that the implied volatility comes crushing out. So RTX does announce next week as well. I went to the trade tab on RTX. I'm just going to collapse that. And because the earnings announcement would be coming next week, the options that have the pricing for earnings is this one here, the October 24th. In fact, all the examples we look at, that's when they would announce. And so we'd look at this and we'd say, all right, implied volatility priced into the near the money options is 47%. And then the next week out is 39%. Further out, it drops a little bit more, but I'm going to look at that next week. That wasn't at least 10%. Now, you could go with a smaller percent if you wanted to, but we're really looking for it to be a lot bigger because we want a big chunk of premium from what we sell in that front week. Okay, so this just wasn't a big enough move. Okay, let's go find another one then. Another one here that had some consideration was, for a minute, was Halliburton, but it's only a $21 stock. So historically, it has been priced higher, but it's just not a big enough dollar price right now. So we passed on Halliburton. One that was looking fairly probable was GE. because it's a $300 stock and it has been making some big moves. Okay. If we go over to the trade tab, the ones with 8 days left till options expiration has 56% in there and 48% in the next week. So that looks like about maybe 12 percentage points higher. Okay. There was a reason that it didn't qualify either. Okay, so I'm going to go to the one that qualified. Okay, so these are kind of the check stuff off the list. Does it do this? Does it do this? Does it do this? Does it have that? If not, we just skip on it. You know, another contender I had considered and looked at was ISRG. And ISRG is a pretty expensive stock, and it has been for a bit. And on this one, you can see implied volatility priced in here, 73%, almost 74 to 59%. Oh, that's a huge difference. That is just juicy. Higher than $40. It just didn't have a lot of liquid options. In fact, the options that we would have wanted to have targeted just had too big of a spread on them. Okay. So like, I'm just going to pick 440 here. Okay. 1630 by 1760 is a little pricey. 2020 by 2130, that's about $1.10. So it's just a little bit too wide, and some of this not having quite enough open interest. Okay. The one that we are going to use here today is Decker. All right, I'm going to pull up DEC. You guys might have a Decker near you. And it has had some decent moves. Big gap here, super big gap down here, big gap down here. We never know which way it's going to go, and that's why we wanted to play both sides of it. If it goes bullish, if it goes bearish. All right. Premiums could be a little bit inflated, but when I was looking at them during the market on ISRG, I was hoping actually to use that as our example, but they were just really wide across the board. So that's why I went on to a new candidate. Okay, these guys don't announce until Thursday next week. I think that's the 23rd. Yep, 23rd. So a week from today, after the market closes, is when these guys will announce. And so we'll be able to look and see what things look like next week, but we'll hold over earnings. Okay. All right. Does it qualify for kind of this higher implied volatility in the options in the week that they announce? Well, it's 109, and the next week out is 90. So that's about 19% higher. So you can go, oh, that's interesting. Now, the market maker move is not showing up here yet. My guess is it'll probably come in there next week sometime. I don't know how soon before a big announcement they come in. I don't know that they have any very specific rules about that per se, but we're going to open up these the front week here, October 24th, because that's when they expire. They'll announce on the 23rd, so we'll have one whole day in the trade. But we were interested in this implied volatility to catch it. So what we do, because the market maker move isn't sitting there for us, we take the at the money straddle. So it ended up closing at 99. Look how nice that was for us, 99.06. So 670 plus 790. Let me get that little calculator out that works well. So we're going to say 670 plus, make sure I'm on the right one, 790. Whatever that is, that's the expected move. So in this case, $14.60. That's pretty close to what I was looking at it. Actually, it's a little bit higher than I was looking at it earlier. So what we're going to do is we're going to round it. Okay, we're gonna round down in this case to $14. Okay, because we took the absolute highest price on the ask, and we might be able to get a little bit closer to midpoint. Okay, so we're going to say $14 difference. Therefore, let's clear this out. If we have the price of the stock, 99 plus 14 is going to give us what? 113. okay? So we would be looking to sell the 113. And what if we do $9 minus? You guys can probably do this in your sleep. Where did it go? Come back, little calculator. I think he's hiding on me. Where'd he go? There he goes. All right. So then we'll take 99 minus 14. That gives us 85. So we're going to be using those strike prices for our call calendar and put calendars that we're going to do together because we really don't know which way it's going to go. Okay. So where is 85 here? I have to scroll up a little bit. Here is 85. It looks like it's like at a 14 delta. And we're going to go ahead and we're going to say, we're going to put these on, I want to put them on as 2 calendars. Okay. We can do it as 1 double calendar. Last week when I showed you how to put on the trade, we did it as 1 double calendar. Today, let's just do sell calendar. That might help some of you as you're kind of piecing together the trade. Okay. So it looks like if we were selling that, would get about 70 cents-ish, and maybe that's looking like a kind of a wide spread there right now, isn't it? That could be artificially wide because the market's closed, but orders keep coming in. When the market was engaged, it was pretty decent, tighter bid-ask spreads, kind of more like, $4 by 420, something more like that, okay? And then on the other side of things, it doesn't really know which one we want to use as our long leg. It doesn't know if we want to go out 1 week, 2 weeks, 3 weeks. It just grabs the next one. That happens to be the one that we're interested in. Okay. And let's just do a blast all and we'll line up the put count or the call calendar here. And we were looking at 113 on it. Very similarly priced, aren't they? This delta is a little bit higher. But at 113, let's go ahead here. And this is looking a little too wonky here. 60 cents by 310, that is not normal, and that's not really what it was, which kind of makes it a little bit more difficult for this example. But we're going to go ahead and we're going to buy a calendar here as well. Looks like this one actually should be not a sell. This one really should be a buy as well. Okay. So 60 cents is one side, one of the calendars. 80 cents is the other side. So initially you're thinking, oh, that's not too bad. As far as a $1.40 outlay of premium. Okay, but let's look at this real quick on the Analyze tab. So we're going to go Analyze Trade and delete that. So I analyze the put trade, and I'm also going to say Analyze the call trade. All right, they're going to be on there together. And let me maybe do a little adjusting here, okay? Kind of looks like a circus tent, doesn't it? That blue line, this is our profit and loss at options expiration. What we want to put in here is actually the one that expires the latest. So we actually want to put in here November 1st. So we'll move our little calendar and pick November 1st. That's the date we want in here. And then this date usually stays at today's date, although you can experiment with it during the week and see, okay, what does my trade look like now? Let's adjust the date. And if you expect implied volatility, you can go in and play with the parameters here. But the big thing I want to stress is we could potentially, if this stock dropped and it was at our 85 strike price at options expiration, this is saying it is, look down here in this little corner, right? About $270 and change. Okay, that's not too bad, right? We are going to plan one of the legs, one of the calendars that it goes significantly that direction, and that one is going to kind of like be the winner and one is going to kind of be the loser, so to speak. Now, if it doesn't move a lot, kind of like what happened on United Airlines is the one that we did last week that and that we were able to follow today. We saw a lot of implied volatility come crushing out, and actually it turned out we were profitable on both calendars, okay? Because we looked for the juiciness in the premium. We were looking for that right off the bat, okay? So we're just gonna do the same thing here. We're gonna send these little guys off. We'll watch them next week. We'll probably come back next week. We'll bring it out here to the Analyze tab. We'll say, what does it look like now? Okay. And I'll probably take a screenshot of what it's looking like as we put it in. Okay, you guys have a few questions here. I'm going to work my way up here. Question is, any reason for $40 minimum? Yeah, because when the price of the stock gets lower, there just aren't, it doesn't seem like there's a big enough movement range to work with strike prices. It's kind of like, oh, we sell this one and then the next one is like, right next to it or something. Okay, it doesn't give you enough room in there. What has been my experience? Your experience could be a little bit different than that. How early do you buy a calendar before earnings? You might do it, you can experiment with this. You might do it anywhere from even the day before they announce earnings, or the moment before you can, maybe out to maybe about 10 days in advance. These are going to be about a week in advance, this particular one. Okay, so good question. All right, I think maybe Cameron has picked up the rest of the questions. Thank you so much, Cameron. Now, how are we going to monitor it? The plan is to stay in. Okay, the plan is to stay in, be in next week, and see what happens over earnings. However, there is a qualifier in here that if implied volatility continues to ramp up, and that front, and therefore the longer legs get some additional implied volatility in them as well. And if we can make a percent that we're happy with, we might get out before earnings. For example, and each person will be a little bit different. If you had a 35, 40, 45% gain on something like this, you might go, man, I'm just going to take the money and be happy camper, get out of our obligation, and just see what happens. Or maybe get out some of the contracts. If you put on 5 contracts, maybe you get out of 3 of them with that percent gain, and then you'll let the other 2 go through the process in hoping that maybe you get one of these bigger payoffs here at the short strike prices. Actually, the one that's at 113 has a much higher max theoretical gain at about $424-ish. Okay. All right. Couple of housekeeping things. I noticed there's a survey out in the chat. You guys know from time to time we'll do surveys. We want your feedback. We want to know how this session was for you. Okay, specific to this session as opposed to all our sessions that we teach. Super easy. Click on the link. Put in the radio button for 1. Number 2, it's just a pop. There's a couple questions if you want to answer, if you want to use it to communicate something with me. I'll encourage you to use it for that. We always appreciate the time that you take to fill the surveys out for us. So I will read every single thing you submit, and if there's something you'd like me to cover, something you ever struggle with, I would like to work it into our sessions, just like I am here with these double calendars, because they're not ones that we frequently have talked about, and you guys are wanting some exposure to some of these additional strategies and where they might fit in the case of today, possibly over an earnings announcement. Okay. Make sure you've subscribed to our Trader Talks channel. It just makes it so much easier for you to find our content. You can find Cameron. You can see what classes Cameron's teaching, which is almost every day of the week as you go out and look at that calendar. Or if you're following a specific series, or say you want to go back and look at what things look like on our trade last week before we got into UAL, kind of that process there. Great to go to the playlist for that. Okay, so subscribe, fill out the survey. If this was helpful to you today, go ahead and hit the like button on the way out. That helps others find the content. These are typical strategies that we cover in here. This one isn't actually on the list. It might qualify in here kind of as a double diagonal, but it's a calendar, so slightly different, using the same strike price versus different strike prices like we might do on a diagonal. All right. How to exit before expiration is a one you want to see. Yeah, you can go close it out anytime. You can go out, right mouse click, create closing order. If you're happy, say you're like happy with what you earned on it or whatever, yeah, you can go out and close it. You can close out one side of it. It's totally up to you. So the trade that I'm entering in today will not execute until tomorrow morning, and I'm going to have to watch it, make sure that we get filled on it. Last week on one of my trades, not in this class, but a different one, I had to go out and change the trade so we could get filled on it. All right, you guys, that's the challenge. This is a strategy you're interested in. Put this in your paper money account, trade along with me, write down the questions that you have along in the way so that next week when we take a look at this, we can address those questions. All right, this is the last class of the day. Appreciate you being here. We'll be back bright and early in the morning at 9:30 Eastern time at the opening bell with Trader Talks on ETFs. You got to be there live because we don't post those, okay? I'll be in the chat tomorrow as well. Thank you, Cameron, for your help. Thank you, every one of you. Have a great evening. Bye-bye.